Hello and welcome to another episode of The Investing Edge. I'm Sumaira Abidi, and with me as always is Feroze Azeez, Deputy CEO of Anand Rathi Private Wealth Management. And today we're going to talk about derivatives. Does that take you by surprise? Well, Feroze, hi. My first question to you is just that, what are derivatives? I mean, people, normally tend to get very frazzled when we say that, derivative investing should be a part of the portfolio. Should it be for traders? Should it be for investors? What's your take?
So, derivatives are instruments which derive its value from an index or an underlying, as they call it. So, a derivative on Nifty, like a futures of Nifty, will derive its value from the Nifty itself. So that's why they call derivatives. There are quite a few derivatives, 4 types of derivatives largely, but the most popular ones are futures and options. Let me take an example of futures to explain the concept of derivatives. There are 2 ways to deal in a security. You take all your money today, pay the money, take the security. That's called the cash market, which we all very popularly know, which is called the stock market, where you pay the money today, you get the security today. That's the cash market. A derivative market is a contract-based promise of a future date. For example, when you go to buy an apartment, you may not register that apartment today. You may give a token money to actually finish the transaction within the next 2 months. So that's a futures contract. So when you go to a person and say, this is your house, I wish to buy this house for a price of 1 crore, but I will just pay you 10 lakhs today. The rest of the 90 lakhs would be paid at a future date when we meet at the sub-registrar's office. So that contract which you come back home with an advance being paid to the seller of 10 lakh rupees in this example, that contract is called a futures contract because you've fixed what you're going to buy, when you're going to buy, and the price at which you're going to buy. But the date is not of today, but it's of the future. That's why those are called futures contracts. This is one example of a derivative, which is futures. Those are also in Hindi called Vaida. It's a promise of a future date. So those are derivatives. And they're very, very important instruments because it helps you use your intellect, your capability better than only a cash market can.
Okay, I take that point about, buying the house and, the part payment later. But mostly if we talk about derivatives, the sense that people have is that this is something that traders do. So is there a wider application in wealth management?
Yes, because derivatives have 3 known applications. One is to speculate. The other 2 are hedging. Hedging, by which I mean it helps you reduce risk. Second application. The third application is arbitrage. When you have one market, which is the cash market, and there is another market, which is called the derivative market, there could be a price difference or an anomaly. Capitalizing on that anomaly is called arbitrage. So derivatives as instruments can be used for any of these 3 things: speculation, arbitrage, or hedging. So traders might use it for speculation, but investors certainly can use it for arbitrage and hedging, which quite a few arbitrage funds, investors who invest in arbitrage funds, in effect are using derivatives for an arbitrage.
Okay. Feroze, there's sometimes a lot of confusion around this whole thing of, the concepts of futures, call, put. So is there a simple explanation, something that, retail investors can understand and assimilate easily?
Sumaira, like you said, there are only 3 instruments in the derivative segment which 99% of investors need to understand. One is the futures, the more so the options, call option and put option. Let me describe a call option. It's a very simple concept. Let's assume that I have a contract which says I have a right to buy from somebody at a specific price on a future date. A contract which says Sumaira has the right to buy from Feroze on 29th of October, which is the last Thursday of this month, Nifty at a price of 11,400. This contract where Sumaira has the right to buy from Feroze at a price of 11,400 on a specified date, which is 29th October, what will she have the right to buy? Nifty. So this contract is called a call option because Sumaira has the right. Feroze does not have this right. He has an obligation. So this contract is favoring Sumaira. So this contract, which is favoring Sumaira, which gives her the right to buy from Feroze on a specific day, is called a call option. Now, Feroze would not sign this contract unless remunerated on day one. If Sumaira has to award this contract to herself, she'll have to remunerate Feroze on day one, saying that sign this contract, which seems disadvantageous to you. I will pay you 100 rupees today. So that 100 rupees is called the premium of the call option. So a right to buy, which was given to Sumaira in this example, from Feroze at a predetermined price of 11,400, for which she gave me 100 rupees so that I'm tempted to sign this disadvantageous contract, is called the premium of the call option.
Okay, Feroze, what would you describe as the key advantages? I mean, what's so compelling about derivatives that investors should sort of make an attempt to understand them or even use them in their wealth management?
Derivatives of the short term are not as useful. Puts and calls of the long term, which are listed on the exchange, are very, very useful because it can help you hedge your portfolio on a 3-year basis. It can help you get an extra return for a marginal risk on the long-term basis. Your assumption is right. All call puts are not relevant to investors. Long-term call puts, 3 years, 4 years, and up to 5 years, which are available on the exchange, are very, very useful instruments to not speculate, but to have calibrated risk and return objectives. I think derivatives can add immense value. That's point one. Point two, derivative as a segment has a rupee value to time and rupee value to volatility. A cash market investor is always worried about volatility. But a derivative market participant, as an investor, can capitalize on volatility and time, because time is a certainty in life. Time will pass. So since derivative has an application of hedging and arbitrage, and also because it can monetize time and monetize volatility, unlike the cash market, these are relevant instruments if could be explained in a simple concept, used in the right proportion, calibrated.
Feroze, can they be executed by investors themselves, or do they necessarily need an advisor?
On an instrument like this, you should have an advisor. You should not execute it yourselves, because there are understanding issues which will take long periods of time, 1-2 years of a learning curve. But also the good part is these derivatives can be put inside a bond and delivered, so that the investor does not have to get to the brass tacks of each of these derivatives. Those instruments are called structured products. That's what Anand Rathi, as a wealth management outfit, has believed in for the last good part of a decade, and added value in terms of creating excess return with a lower risk. So to answer your question, Sumaira, all of them don't have to actually understand it threadbare, but should conceptually definitely understand, because its application and value creation is enormous, as seen by data of the last 15 years of the structured product industry.
Okay, Feroze, you mentioned lower risk. So one, of course, what is the risk in derivatives itself? And, if you advise, like you did, that, go through an advisor, so therefore, use it in the form of structured products, what's the risk factor there? I mean, for either going it alone and going it with an advisor.
See, going it alone is a risky attribute because emotions come into play, especially when it is standalone investor managing his own derivative portfolio. Because it's like fire. You can cook with it or you can burn your house down. It is largely about the proportions. Wherever you see people going beyond their means of their portfolio in the aspiration of making it big is when derivatives can be very harmful. So to control your proportions, an advisor is needed. to control the other nuances, and productized derivative, which is simple with negligible management or zero management during the life, is a very, very good second alternative. So understanding the concept and using an advisor in a product format, taking a derivative in the right proportion is a very, very good idea.
Okay. And Feroze, you had mentioned earlier on that, there can be many types of derivatives, right? F&O being one of them. What are the others? Is there anything else that can probably be handy for an investor?
Yes, especially for NRI investors, this conversation, because Indian derivative market largely focuses on options and futures. There are other two very interesting derivatives. One derivative is called a default swap. So if you believe that a company is the bond which you own has a probability to default, you can buy a default swap, by which you mean if the bond goes default, it's an insurance of credit of sorts. In the last few years, we have seen a lot of debt funds have bonds which defaulted. If there was a derivative in the form of a default swap, at a cost, those portfolios could have been insured for an exigency or a contingency of a failure of a corporate to repay the money. That's one derivative, the third type of derivative. The fourth, for academic purposes, just to create curiosity amongst the viewers, those derivatives are called interest rate swaps. If I have a home loan which has a floating interest rate, I can convert it into fixed or vice versa. That interest rate swaps help you swap your interest obligation from floating to fixed or vice versa. So these are the four most popular derivatives. In India, two of them are popular. The other two are globally very popular, but I don't think India has developed that market yet. And I hope and pray those develop, because from a risk management standpoint, default swaps, which especially when you have funds having bonds which defaulted, if default swap market existed at a price, you could have insured those portfolios against defaults.
All right, on that note, we're going to take a quick break. We'll be right back discussing some more ideas for wealth management. Stay tuned, we'll be right back. Welcome back. You're watching The Investing Edge, and with me is Feroze Azeez, Deputy CEO of Anand Rathi Private Wealth Management. Hi, Feroze. So we've spoken about derivatives quite a bit, and we come back to mutual funds now. A lot of people have had this complaint that active funds are not performing, and we've seen that in this PIVA report that this whole active-passive debate seems to be reaching some sort of momentum in India as well. So what is the reason that active funds are not performing? I mean, what's gone so wrong so suddenly?
Active funds have not performed for 3-4 reasons. One is the last 2-year pocket has not been very good for the broader market. When the broader market performs and the active funds are underperformed, that's a very, very negative sign. Okay, it's 1 into 0 is a 0. It's not 0 into 0 is 0 in this case. So what do I mean by that is, if the broader market did very well over the last couple of years, which didn't happen, and the fund manager couldn't generate an extra return, then it's a very, very bad sign. Currently, it's not the case. Last 2 years, broader markets have been disappointing, right? There could be pockets of 10, 15, 20 days where mid-caps, small caps, all stocks of index ran, but it's been a very concentrated rally. Second is, of course, there has been SEBI regulation, which curtailed a lot of freedom a couple of years back. That's been one peripheral reason, but not the core reason. Third is index weightages of specific stocks have superseded the maximum allocated money a fund can have in a specific stock. So these three are the primary reasons. I personally very strongly feel generating alpha would be difficult going forward, but not for all of them. Identifying the schemes is becoming more and more important. Earlier, you throw a dart, you would find a fund manager who would beat the market. Now, a lot of analytics in terms of understanding the fund manager, his capability, the fund's potential, and then buying it. Earlier, past performance would do the trick for you. Now, analyzing 457 to arrive at that 8 to be able to generate alpha will be critical. Don't leave the path of value for some small cost saving of 1% or 1.5% by going into passive funds.
Okay, so Feroze, would you agree with the call that for the large cap end of your portfolio, go with an ETF or an index fund, and in the mid cap, small cap space where the ticking brain of a fund manager is still required, go with an actively managed fund?
Yes, Sumaira, your point is valid. The case for a large cap allocation into ETF is larger or greater than in the mid cap and small cap space. But data says a little otherwise. Last 1 year in the large cap space, the best and worst have had a 15% difference. So a 15% difference in the same category exists. So it's not going to be dependent on that 1% cost saving. If you got the second best, you will be significantly better than the second worst. So if there's a dispersion in the same category of 15%, I don't think that ETF is the solution today. But 5 years later, I definitely agree with you maybe. Today, it is to be more specific, more vigilant to identify the schemes which can be on the top quartile or the top decile of a given segment. But point taken that it's more of a case in the large cap space, a passive, than it is in the mid cap and the small cap space.
Feroze, thanks very much for that. And here's some very interesting mutual fund analysis coming in from Adil Chako, who's a director and unit head of Delhi at Anand Rathi Private Wealth Management. Over to you, Adil.
Thank you for having me on the show, Sumaira. Today, I will be talking about Nippon India Large Cap Fund that was earlier called Reliance Large Cap Fund. So Nippon India Large Cap Fund came into being in August of 2007. It currently has assets under management of 10,616 crores and is a large cap fund as categorized by SEBI's classification. Its fund manager is Mr. Sailesh Raj Bhan, who has been its fund manager since inception. He has 24 years of industry experience and 14 years of fund management experience. Mr. Bhan's management style is a mix of growth and value with a skew towards value-based investing. This fund is a diversified fund invested across 46 stocks across 10 to 11 sectors. The fund is a fully invested fund which has 80% of its investments into large cap category stocks and the remaining 20% of its investments into mid cap and small cap category stocks. Now we have evaluated this mutual fund using Anand Rathi's mutual fund ranking methodology and evaluated it across parameters such as risk, volatility, fund managers' stock picking capability. With regards to historic parameters, this fund has fared poorly, specifically in terms of risk and returns. However, with regards to futuristic parameters, this fund has fared well. We have given an overall rating of 2 out of 5 for this fund. Now, if you were to measure its performance on the basis of 3-year rolling returns, this fund has delivered a negative 2.37%, whereas the category average has given a positive 0.58%. The Nifty has given a positive 1.32%, which is much higher than the fund. If you were to consider risk and measure that using standard deviation over a 3-year period, this fund had a high standard deviation of 23.36%, whereas the category average was 19.86%, and the Nifty's standard deviation was 21.25%. With regards to valuation, however, this fund ranks better than its peers if you were to consider its low PE ratio and its low PEG ratio. In summary, I would just like to repeat that our overall ranking for this fund is 2 out of 5 basis Anand Rathi's mutual fund selection methodology. Thank you.
Adil, thanks very much for that interesting take. With that, we'll wind down on Investing Edge for this week. Thanks very much for watching. The news continues on CNBC TV 18.